Welcome to The Commercial Edge, the podcast where business, property, and legal insight come together. I'm your host, Elizabeth Rebolito, lawyer, founder of Ardor Legal, and your guide to navigating the commercial world with clarity and confidence. Let's get into it. So today we've got Matt Weber from LendSmart with us. Matt, I'm going to come over to you. Let us know a little bit about who you are, what you do, and what you love most about your job.
Sure. So Matt Weber, I am a finance broker specialising in commercial. I have over 15 years lending experience. The last 11 of that has been in the commercial space. And what I love about it, I love the technical aspects of commercial. I love working with business owners and property investors, and just the fact that there's so many different asset classes and specializations within the industry. No 2 days are the same.
There's a lot of varieties.
There sure is.
Fantastic. All right, so I want to delve into what our topic is today. We're talking all things commercial property, of course, but the one thing I wanted to start with was this mindset that we've been sort of in some way, we've been hearing this all our lives, how important location is in buying property. Tell us, Matt, from a financier's perspective or from your perspective, how true is that?
Look, I know we're here talking about commercial, but I'll start by talking about residential because that's what most people are familiar with. Like everybody has, lived in a house, whether they're looking to buy or rent or not, but, just about everybody has lived in a house. The things that really drive that is, there's aesthetic appeal, there's school catchment areas, there's the swimming pool that they see their kids, and there's a real emotional attachment to it, and that can create that desirable. I mean, I live in Tarragindi, right? So as soon as I say Tarragindi, everybody knows, oh, that's a leafy suburb. I love Tarragindi. So there's that. That's not how commercial works. And, if you're a logistics business, you might have a preference to have a location that's closer to some of those, arterial main roads for access and to reduce your driver time. But from a lender's perspective, and that's the lens that I'm always looking at things through, it really doesn't matter. There will be two things that come through on a valuation report. And a valuer will say what they suspect the reletting period might be for an asset and what they suspect the resale period might be for an asset. And that may be slightly influenced by location in some scenarios, but outside of that, lenders don't really care.
Mm-hmm. Yeah, so you might have, for example, a pub out in the middle of nowhere, which has a really great tenant.
Yes. Or
a cafe in the middle of the CBD. Not a very secure tenant.
No, it's a tough game, isn't it?
It really is. So in terms of the buyer's lending requirements for a commercial property, what are the types of things that the bank is looking for?
Right. So as a bank and an ex-banker myself, we tend to start from the worst case scenario and then we build our way up from there. So I was always taught when I was cutting my teeth in the banking industry, where we're not really dealing with money, we're dealing with risk. So some of the things that they're going to look at is, if you've got a multi-use or multi-tenanted commercial asset, the banks are going to go, okay, what's the management risk? Does the person that's buying this have the ability to manage this asset? And you could mitigate that with, well, they're actually going to have a agency or a property manager on board to manage that. So that's an example of mitigating a risk. There's the financial risk, and this is where the lease comes into play. What is the return on that asset? What plays into that would be tenancy risk. So you mentioned a cafe before. So if you compare, say, a cafe that's been trading for 2 years as opposed to, let's just say a super cheap auto as a tenant, which one's going to have more strength and more security? So that's a little bit tenancy risk. Industry risk is one thing that comes into it. I'm going to use a bad example here. I'm going to talk about service stations. Service stations are quite popular and solid right now, but as the rise of EVs started to come in, there was a period there a couple of years where people were uncertain about what's the future look like for something like a service station.
They're generally long-term tenancies as well, aren't they?
Yeah, they really are. But to go back to tenancy risk, I feel like I'm going to talk about service stations today. You can have two main kinds of tenants in a service station. You can have an independent owner that
Mm-hmm.
operates under a badge, whether it be Puma, BP, or one of the others, or you could actually have the corporate tenant.
Sure.
So if you're comparing those two, same industry, same location, same asset, which one are you going to prefer? Well, it's obviously going to be the corporate one. What have we got? Vacancy risk. That's a big one. Do you have a tenant? Does your tenant have options, and are they likely to exercise those options at the end of that period? Because when your tenant goes, so does the money.
Sure. We've got on that note with the tenancy, we've got a case at the moment that we're doing a commercial sale in, where there's multiple tenancies in the shopping centre that the seller is trying to sell. However, a lot of those tenancies are don't have any leases. They might be on a holding over. Leases may have expired. From a purchaser's perspective, what would the bank be looking at in that type of to finance that purchase, and what would they want to see changed?
So in that scenario where you've got no lease security
Or minimal lease
security, especially your big four banks, which have the privilege, I suppose, of being a little bit more risk averse, in general, that income is going to be considered speculative. That they might not even count that income at all. So if you're purchasing that asset and you're gung-ho, I want this asset, but the lease income, the definite lease income, is not sufficient to cover the interest expense by a certain ratio. This is one of the metrics that the banks will use, and I might chat about that a little bit later. But if the income from the asset is insufficient, then the bank is going to look for, well, where do I get more income from? So they might be taking income from the purchaser, their personal income, whatever form that comes in. They might look to take a guarantee over a business that generates income. So the bank just wants to make sure that they have sufficient income to cover the cost of that interest. And when I say a guarantee, that's a guarantee is practically an IOU that says if the borrowing entity can't meet the loan repayments, then the guarantor will.
Right. I guess in terms of the income and the actual tenancies, the bank's not really interested in the potential income or changes in the tenancy post-settlement?
Some lenders will consider it,
Okay.
and they will look at a market rent value, especially your non-bank lenders. But my experience with your major banks is that they're probably not going to count it because they don't need to take that risk. They've got the business coming through the door. They've got the name. Like I said, they're in a privileged position where they can be a little bit more risk averse.
With those types of multiple tenancies, would one solid tenant sort of save the deal, or what would they be looking at in terms of if it's got you've got your big shopping centres with your Coles, your Woolworths, your IGAs and things like that?
Yeah, big anchor tenant. That absolutely goes away. So what does an ideal tenant look like? Well, that is a long-term lease, greater than 10 years, ASX listed company, not a guarantee, but they are definitely looked on favourably. So you use Woolies and Coles as an example. They are a tenant who very, very rarely do they vacate a store.
Sure.
So they're kind of there for the long term. What I have found sometimes with those Coles and Woolies leases is that they can actually be really, really aggressive in terms of their negotiating power. So what I have
They know where they stand.
They really do.
Yeah.
And they use the term anchor tenant for that, and for good reason too. I've seen lease conditions whereby if it's a Coles or a Woolies and they say if the surrounding shops, so imagine a retail setting where you've got a big Woolies and then you've got 10 other little stores around it. There might be a Baker's Delight, there might be a florist, there might be a newsagents, a little coffee shop, something like that. Those big, powerful tenants will have a clause in there whereby if 70%, if the occupancy of the surrounding tenancies drops below 70%, that Coles or Woolies get a discount on their rent because it doesn't look good for their store.
Of course, yes.
So they'll negotiate a whole bunch of different things in there. And quite often, their strategy will be, and I think what's the TK Maxx? TK Maxx is really known for this. Now, there's a good hardcore retailer that drives a lot of foot traffic. So they'll go in, they'll negotiate the heck out of their lease term, and the landlord is going to make more money off the surrounding tenancies because once that TK Maxx is in there, or a Coles or a Woolies, it brings in the foot traffic. So all of a sudden their tenancy is more desirable. So we've got negotiating power there, right?
From that tenancy.
I don't know if I answered your question there, Liz. I think I went off on a tangent.
It's totally okay. You gave us some good stuff. I love talking tenancy, so you'll see that in my questions. But in terms of the tenancy, is there a particular type of tenant that the banks? So you're buying a property, there are some tenancies in there. Is there a type of tenancy that the bank will say that's a red flag, we're not willing to purchase, or whether they're weigh heavily on sort of like that, I guess, that risk palette for the banks?
Yeah, right. Ideal tenant, ASX listed company with a long-term lease. Bang. That's the gold standard, right? We can't all get that.
The unicorn?
Yeah. So the way banks will kind of manage that in terms of weighting their risk, I touched on it before, the how many times does the income, the net income from the lease, cover the interest on the asset? Now, the ratio that they use is ICR, so interest cover ratio. Now, if you look at a tenant that's a ASX listed or light industry will often fall into this category, that ICR metric might be, 1.35 times or in some cases as low as 1.1 times. So,
sorry, before you go on, could you elaborate on what ICR is?
How does that work?
Yes.
Yeah.
How does it sort of,
let's
used? Yeah.
Let's use some round numbers, right?
Okay, fantastic.
So let's just say the interest expense for the loan is $100,000 a year. If you have an ICR metric of 1.5, that would mean that the net income that's going to be used to service that debt is going to need to be $150,000.
Where does that metric come from?
So the banks will use that metric to manage risk.
Sure.
So if you have your ASX listed company, their ICR interest cover ratio might be 1.1, so that's 110,000. But if you have a cafe or a retail strip shop, the bank might decide that their ICR metric is 2 times, which means that the income coming in needs to be 200,000. So the way that you can meet that metric is you can either reduce the loan amount, thereby reducing the interest, or, well, that's and that manages their risk.
Yeah. And what do you say, or what would the bank say about sort of tenancies? Look, in our industry, when we're looking at commercial leases, we advise our clients on potentially high-risk tenancies, for example, with the new vaping laws that have come in. So those types of things can increase the risks for our landlords if they've got tenancies in there that might have the tobacco shop, that had the vaping equipment and the likes of that they might get flagged if they're not appropriately licensed. So we have an obligation as lawyers to advise our clients of those types of high risks. We're also aware of, for example, tattoo parlours being like the insurance for insuring a tattoo parlour, whether it's the landlord's insurance or otherwise, is phenomenal. Do the banks look at those types of tenants as well?
Yeah. And to use the example of the vaping shop or the tobacco shop, those shops are also at much higher risk of being broken into. So you've got a risk there. There's it's harder to get insurance for the tenant. There's also risk to the property itself. So yeah, banks will be very, very reluctant to look at something like that. Another example of a bad, not necessarily a bad tenant, banks might consider branding risk.
Okay. Yeah.
So if you've got a legalized brothel, or an adult entertainment venue, legitimate business.
Legal.
Great cash flow. Pays rent in advance, on time. From a financial perspective, there's nothing wrong with them. However, a Big Four bank might not want their name associated with that building for that reason.
Yeah. What's a typical mistake that you see buyers make when they come to you with, "Oh, I've found the perfect property, I think it's wonderful." What are those key mistakes the buyers are making?
A couple things, and they do kind of tie in neatly together. If you've got a really high, a shorter term lease,
Mm-hmm.
so like, maybe only 1 or 2 years, number one, most banks will only lend to the term of that lease because, as I said before, if that lease doesn't renew, then the income stops. And another risk that ties into that is when you've got the passing rent, which is the rent that the property is currently earning, and the market rent. So if you've got your current rental income is significantly higher than the market rent, what that means is that at the end of that lease, when your tenant leaves and you get a new tenant coming in, you're getting less income. And as I said, the value of a commercial asset is largely around the income that it can generate. So whereas your residential market values are kind of driven by, desirability and a little bit more the location, the market value of a commercial asset is much more heavily driven by what the actual income that is. So let's just take an example. Someone's bought an asset. The bank has decided that you can lend up to 65% loan to value ratio. So say it's $1 million property, that's $650,000, and you've got this really, really good lease and it's in place for 2 years, and then that tenant vacates and all of a sudden you're earning a lot less rent with your new tenant. Well, straight away, the market value of that property has dropped. So now that property is only worth $800,000, for example.
So what's the risk to the buyer in that circumstance?
The bank might come knocking and say, hey, we're overexposed on this asset. To manage that 65% loan to value ratio that we want, you're going to have to pay back some of this debt and reduce that loan amount. And if the buyer can't do that, the bank may
rely on securities, guarantors and things like that.
Or it changes the risk profile of that loan for the bank. So when that loan renews, and as I said, the loan will typically renew when the lease does, you might not be getting the same rate. So all of a sudden, your rent has gone down, your interest expense has gone up. This might not be a viable commercial transaction for you anymore.
It's not as profitable as you thought it might be.
It could even be a drain on cash flow if the change is significant.
Oh, that's a little bit of a risk. Now, you mentioned to me, not today, but in the past, you've mentioned to me a terminology, whale. I've heard it a few times recently, but it's not something that we come across in the legal industry a lot. So I'm assuming it's very much financier based. Talk to me a bit about what is whale. It's not the big fish in the ocean.
No, it's not. It's not. It's not spelt that way either.
Okay, talk to me.
And Leroy Day does a fantastic explanation of this on his socials. So whale, W-A-L-E.
I'm writing it down.
Weighted
W-A-L-E.
average lease expiry.
Okay.
So the weighting part of it, it's weighted by the revenue that comes in. The lease. So this is, if you've got a single tenant with a 2-year lease, well, it's really easy to work out the whale, right? 1 tenant, 2 years, 2 years is the whale. But if you've got 10 different tenancies, all with different expiry dates, so one might be 10 years, but another might be, 1 or 2 or on periodical, things like that, then you're trying to work out, well, what's the average lease expiry? And it doesn't go by tenancies, it goes by revenue. So if we go back to that strip shop where you've got your Coles or your Woolies, and then you've got the 10 shops around it. Now, let's just say all of those 10 shops around it have a 10-year lease. But the Woolies only has 1 year left on its lease. That Woolies, because of the floor plan, it's probably making up 80 or 90% of the income from that asset. So your whale, your weighted average lease expiry, might only be a little bit over a year.
Okay. Oh, okay.
I hope that makes sense.
A little bit.
And it is definitely a financier term. Yeah. And to the point that I was talking about before, why is this important for lenders? A lender will typically only lend for a period equivalent to the WALE. So if you've got a 1.5 year WALE, that loan term is going to be for 1.5 years. So what the banks will do at the end of that 1.5 years, they will review the loan. Has that lease renewed? If that lease has renewed and the WALE is now another 2 years, well, happy days, we'll renew that loan for another 2 years. If that tenant vacates and all of a sudden everything has changed, the bank now has a right of review on that loan. So the rate might change. They might ask you to reduce the debt because the loan to value ratio is now outside of what the bank is comfortable with. The bank may, in dire scenarios, the bank may sort of pursue, how do we get out of this loan?
In terms of the bank's process in financing purchases, what kind of due diligence do they do? Because, from our perspective, if we're doing a due diligence for a commercial purchase, we would dive quite deeply into, for example, tenant history, securities, has it got a bank guarantee? Again, we do also look at, whether there is personal guarantees attached to that as well, that the insurances are in place. How much of that does the bank also look at, or do they sort of more do a surface level inquiries?
I'd probably say it's a bit more surface level than the depth that you go into. We do have different strengths in tenancies, like we discussed before, but and the guarantee, probably wouldn't really look at the guarantee. It's probably this is the thing, when we're lending, if we're lending for a commercial asset that our borrower is going to operate their business from, well, then we've got access to that business's financials. Whereas if we're doing a commercial investment loan, well, we're not allowed to go and ask the tenancies for all of their financials to make sure that they're going to be able to meet their obligations and see out the lease. So we kind of just take a broader look at it and go, okay, well, that's a Woolies, so happy days, or that's a little cafe and a massage parlour.
So who are the tenants and what are the lease terms,
yes,
that type of scenarios?
Okay. Absolutely.
So I guess there may not be anything a seller can do, but to assist the buyer to secure that finance, is there anything the seller can do or cooperate with?
Really good thing is if you're looking at a commercial purchase where you've got some periodic leases or short-term leases, is make it a condition that those leases are actually going to be rewritten and extended before the settlement.
Okay.
Another thing, I know agents will probably do this a bit, is that they'll reach out to the tenants and try and get a verbal indication of whether they're likely to renew or not. But, verbal's nice. A lease is better.
Yes, absolutely. So I guess from a seller's perspective, to ensure that you have a quality buyer that can finance the purchase, having your lease documented and having those strong lease tenancies in place as well, with the longer term tenancies, would provide sort of strength and reliability for finance.
If you're a seller, absolutely, you would want to do that, because the easier it is for your prospective buyers to get finance, the more buyers you can potentially have, and the more competition. I guess the only caveat to that, and I don't know that it really applies, if you for some reason felt that your asset had more attraction and more value as an owner-occupied premises for somebody to move their own business into, well, getting the leases renewed just before is probably going to work against you. But I mean, that's.
I guess it depends on what you're selling as well. So if you're selling a shopping centre, obviously you would want to make sure that as many of those leases are secured. Potentially owner-occupier, what kind of assets do you see more so for owner-occupiers?
Light industry.
Yeah,
for sure.
So
yeah.
Talk to me about that.
The light industry is good because you've got so many different businesses that can fit into it. So if you've got a shopping centre, it's only good for retail, right? If you've got a childcare, it's only good for childcare. But if you've got light industry, like a warehouse with a mezzanine, an office and a toilet, you can have a retailer using it for storage. You can, a wholesaler. You can have a manufacturer if they're manufacturing things on a smaller scale that can operate out of there. You can have somebody who wants office space, and they might have a jet ski and a trailer, so they're self-employed. They've got all the toys, and they store the toys in the warehouse, but they run out of the office.
Of course,
like you just see, there's so many different
potential use.
Absolutely. And you've got, the wider that is, the broader that is, the more potential buyers or leases you'll have.
Fantastic. I did have a follow-up question, but I've lost it. All right. Without naming names, can you give us an example of where a deal has gone wrong, or you've been unable to secure finance as a result of potentially the tenancies or some other sort of factor like that we've talked about today?
Yeah, I've had a few hurdles and challenges across a few different ones. I can think of. I'll talk about a few, and not all. Most of these actually went ahead, but these are the challenges that we had to work through, the mitigating of the risks that I was talking about before. We had a client purchasing 40 units, residential units. Now we consider this commercial, right? Because it's not your average mum and dad that want to buy 40 units. In that scenario, we use what's called an in one line valuation. So that valuation, in terms of the bank valuation, is going to be a fair bit less than the value of those units being sold individually. And the reason for that is, if you're a bank and you have to sell off this asset, you can't just dump 40 2-bedroom, 2-bathroom units onto the market and expect to sell them. You're going to have to slowly sell those over a period of about 18 months. So the market value came in a bit lower. The buyer had to put in a little bit more cash than they originally wanted to, but he was a well-cashed up buyer, so he was able to do that. This one was one that was already approved, and we were talking about niche and specialisation. This was a cold storage facility out at Gatton. Unlike light industry, cold storage is really only good for cold storage. When his tenant didn't renew, he was left in a bit of a challenging spot. There was a big vacancy period, and there was a bit of back and forth with the banks to try and keep that checked in. We talked about how good an ASX listed tenant is. It's not a fail-safe. I did have a client who had a wonderful asset that they'd purpose built for an ASX listed company. At the end of that lease, which was 5 years with a 5-year option, that ASX listed tenant decided not to renew. And fortunately, it was a really, really good asset, but they were in that position where, like, okay, now we're looking for a new tenant or a buyer. They got lucky. Blackstone actually came in and snapped up that asset. It was a good asset, right?
Yes.
What else? Oh, I got one. This is a cracker. This is a unique situation. This is probably more commercial development, but he had this site and he'd had it for a long time, but there was infrastructure that ran underneath at the entry to that property. Now, because TMR, Transport and Main Roads, had to do all this infrastructure work for a period of over a year, there was no access to his site. And obviously, TMR do really, really important work, and infrastructure is really important. So they kind of push their weight around, and it's like, we can appreciate that, this makes things tough for you, but this is more important, so too bad. I've got more, but we'll stop there.
Ouch. All right. So rapid fire takeaways.
All right.
Just wrapping it up. So quick and easy. One lease issue buyers often miss early.
The expiry of the lease, for sure. I think first-time commercial property buyers are sometimes oblivious to the vacancy risk with commercial tenancies, and the scenario that I described before, where they're getting really, really good rent, but it's well and truly above what the market rent is, and the dramas that they can find themselves in when that lease ends.
Definitely. One key difference between resi and commercial buyers. What do they misunderstand?
I mustn't have understood the question properly because, hang on, I must have understood it because I'm not going to give you one.
Just one.
Outgoings.
Outgoings.
You want me to elaborate now?
Yes, quickly.
Commercial leases, especially in something like light industry, if you get a triple net lease,
Yes.
I know term, that is going to cover everything, including land tax and building insurance and all of that. The tenant can cover all of those. But if you look at a retail lease, for example, they're a bit more protected and they might only be paying for their own insurance. And so you might have higher outgoings.
Correct.
So the net income can be quite different to the gross.
And when you're looking at resi, you don't pass on those additional costs at all.
Exactly.
So it's very different from a commercial perspective, how we address outgoings.
Yes, there's a lot more that's negotiable in commercial, whereas resi is...
We love commercial tenancies.
We do.
One action buyers should take before committing to a deal.
Get your borrowing entity sorted properly. So the term here is SPV, which stands for Special Purpose Vehicle. So there's pros and cons to purchasing in different entities. So the main entities that we see would either be a trust, that's probably the most common one, a bit of asset protection
trustee.
with a corporate trustee is definitely preferable. You can buy it in a company, but there's reasons why most people choose not to do that. You can also purchase it in your own name, and there's reasons why you shouldn't do that. There's also reasons why you should. But yeah, before
talk to a specialist about those things.
Get
and
your
make
team together. Yes,
absolutely. Talk to specialists about those things before you actually purchase a property. So you talk to your accountant, talk to your broker, talk to your lawyer, to make sure that you've got the right structure, the right setup, before you even find that property.
Understand your structure and understand why you're using that structure. A lot of times I do get people that have, bought stuff and they've got all these different structures and it's like, well, why is it set up like this? Like, oh, I don't know. So
last question, I promise. One key takeaway from today, what do you think if you could pre-warn a buyer on how they should approach a commercial purchase? What do you think would be that key takeaway for today?
Understand the risks. And we rattled off a whole bunch of risks, but this is something that is good about commercial is, I feel anyway, it's a little bit more black and white. You're not worried as much about location and catchment zones and all that kind of stuff. It really is what risks are there with that asset and what do the numbers tell you?
I'll say the one thing I like about commercial is that most people, not always, will approach a commercial from a commercial perspective rather than an emotional perspective, which you might see differently with residential purchases. However, there are times where a buyer is so committed to the purchase that they turn a blind eye to those risks to their detriment post-settlement. Even if they can get the finance, they are still looking at risk. So it's the finance risk, but it's also that risk post-settlement, having to live with a purchase that you've acquired.
Yeah, there's really three key things you can do with the risk. You can either mitigate it, you can accept it, or you can walk away. And
avoid
that scenario that you've described, that's them, whether it's consciously or unconsciously, they have accepted that risk.
Yeah. Potentially without completely understanding it. That's my biggest takeaway with clients that are accepting risk. We're okay with the clients accepting a risk that they understand and that they've taken into account. However, the risk that they don't understand and that catches them by surprise is the one that we're very cautious with.
Yeah, what's the I can't remember who this quote is attributed to. The fear is in not what you know, but it's not what you don't know, but what you think you know, but just ain't so, or something along those lines.
I like it. I'm going to have to look that one up. All right. Look, thank you so much for today, Matt. It's been such a pleasure having you on the show. Love talking to you, and I know you and I can talk for hours on all things commercial, all things leasing. How can people find you?
You can find me at the website at lendsmart.com.au. I'm not too good with the socials, but Matt Webber at Matt Webber LendSmart on Instagram and also Facebook.
Fantastic. Thank you so much.
Thanks, Elizabeth. Pleasure to be here.
You've been listening to The Commercial Edge. the podcast where we dive into the real stories, strategies, and legal insights behind smart business and property decisions. I'm your host, Elizabeth Rebolito, lawyer, founder, and fellow entrepreneur. I'm so glad you joined me today. If you've got value from this episode, make sure you follow the show so you never miss a conversation. And if you're building, buying, or growing something great, head to ardorlegal.com.au. We've got practical resources, guides, and legal support to help you move forward with confidence. Thanks again for tuning in. I'll see you in the next episode.